Welcome to Talk Tickers. We dive into earnings calls to pull out the key insights for experienced investors.
Hey there.
Today, we're getting into the Fastenal Q1 2025 call. Lots to unpack.
Yeah, definitely. So let's start with the top line numbers. Sales, they grew modestly, about 3.4% year over year.
Okay, 3.4%, but wasn't there something about the daily sales rate?
Right, exactly. The daily sales growth was actually stronger, up 5%. It's just they had one less selling day this quarter compared to Q1 last year. So that kind of skewed the overall number down a bit.
Okay, that makes sense. So daily activity was a bit better than the headline suggests. What about profitability? Margins?
That's where things got a little tighter. Operating margin dipped slightly to 20.1%. That's down 50 basis points from last year.
50 basis points. And gross margin?
Similar story there. It came in at 45.1%, which was a 40 basis point drop year over year.
So some pressure on both operating and gross margins.
Got it.
And earnings per share?
Flat. Stayed right at 252 cents, same as Q1 2024.
Okay, flat EPS despite the sales growth reflects those margin pressures, I guess. But they did bump the dividend, didn't they?
They did, yeah. Just a small increase from $0.43 to $0.44 per share.
Still, if that holds, you mentioned it could be, what, $1 billion in total payouts for the year?
Yeah, potentially pushing $1 billion in total dividends.
Huh?
It's a decent return to shareholders, especially, given the flat earnings.
Right. So let's dig deeper. Management said the market is still sluggish.
Yeah, that was the word they used, sluggish.
Yeah.
They basically attributed the growth they did get mostly to their own initiatives, what they call self-help, and also just easier comparisons to last year.
But they did see some positive signs sequentially, month over month.
Yes, that was interesting. They noted strong sequential patterns across all their geographies.
Yeah.
Even after adjusting for the bad weather in January and the timing of Easter shifting things in March.
Okay, so underlying momentum might be building even if the overall market isn't exactly roaring back.
Seems that way. But a big challenge they flagged was tariffs.
Yes, the new tariffs, especially on fasteners and steel products, right? That's core for them.
Absolutely core, and it's a significant headwind. They've already started taking pricing actions just this month, April 2025.
Okay, so they're passing costs on. How much impact do they expect?
They're estimating it'll add about 3% to 4% to price in Q2. But they also said that impact could potentially double in the second half of the year.
Double? Wow. That's a big potential increase. How are they managing that risk besides just raising prices?
Well, they're working hard on diversifying the supply chain, trying not to be too reliant on single sources or regions, and, talking constantly with customers about options and flexibility.
That customer conversation is key, I imagine, especially given that divergence we saw between customer types.
Definitely. That was another really interesting point. The large accounts, the ones spending, say, over $10,000 a month, showed strong growth.
Okay.
But the smaller accounts, particularly those under $5,000, and really the ones under $2,000 a month, they underperformed. Quite a bit, actually.
So the big guys are sticking and growing, but the smaller ones are lagging. Did management have a theory why?
They pointed pretty directly at their own e-commerce capabilities. They feel they need to improve the online experience to better serve those smaller customers who increasingly just want to click and buy online.
Right, less high touch needed, maybe more seamless digital. It contrasts with their big success story, the FMI program, doesn't it?
It really does. Fastenal Managed Inventory, their vending and on-site solutions, that continues to be a huge driver. Device deployments were up 12.5%, nearly 130,000 active devices now.
Impressive growth there.
Yeah, and it shows how embedded they are with those larger clients. Overall, something like 43% of revenue now goes through some kind of tech platform, FMI or otherwise.
And the broader digital footprint, e-commerce included.
That hit 61% of total sales. Their target is to get that up to somewhere between 66% and the 68% by October this year.
So big push on digital, but maybe needing refinement for that smaller customer segment. Let's talk inventory. It was up quite a bit.
Yeah, up significantly, almost 12%, 11.9% to be precise.
Why such a big jump?
Two main reasons, they said. One, just improving product availability, making sure they have stock to support customer growth. And two, it's a proactive move, basically stocking up ahead of potential further tariff impacts, hedging their bets a bit.
A buffer, essentially. Okay.
Yeah.
And that ties into higher spending plans overall, too, right? CapEx.
Exactly. Capital spending is projected to jump quite a bit in fiscal 25. They're guiding $265 to $285 million.
Compared to
$214 million last year. So a pretty substantial increase.
And where's that money going primarily?
More FMI devices, obviously supporting those large client wins, big IT projects to boost those digital capabilities we talked about, and expanding their distribution centers, investing in the infrastructure.
Makes sense. Investing for growth and efficiency. Now back to the margins for a second. The gross margin slip, any color on why, beyond just general pressure?
They mentioned product and customer mix playing a role, which probably relates to that large versus small customer performance difference, and also higher costs for third-party freight.
Okay, but they do expect comparisons to get easier later in the year.
Yes, they anticipate easier gross margin comps in the back half.
And SG&A, selling general admin costs.
They increased slightly, but management made a point about the selling days again. They said if you adjusted for the fewer selling days this quarter, they actually would have shown leverage, meaning SG&A would have grown slower than sales.
Okay, so underlying cost control is still pretty decent, it sounds like.
Seems so. Though they did hint that incentive compensation might tick up later in the year if financial performance improves as they hope.
Right. Makes sense. So boiling it down for the listener, it feels like Fastenal is showing resilience, executing internally despite a tough market.
I think that's fair. It's not demand pulling them forward right now. It's their own initiatives, their FMI strength.
But those tariffs are a big watch item, and how well they execute that e-commerce improvement for smaller customers. That seems crucial.
Absolutely critical. The pricing power related to tariffs is a big question mark. And that divergence between large and small customers highlights the need to get that digital strategy right across the board.
Okay, let's pivot. Time for our This Is Not Financial Advices segment. What outrageous but plausible trade idea did this call spark for you?
All right, here's one to chew on. How about going long Fastenal, but shorting a basket of, say, pure play e-commerce retailers that target small businesses specifically?
Interesting. What's the thinking there?
Well, the idea is if Fastenal can successfully beef up its e-commerce for those smaller MRO buyers, while still leveraging its high-touch service and FMI for the big guys navigating complex supply chains, especially with tariffs, maybe their diversified model outperforms those pure online players in that specific small business segment.
So a bet that the traditional distributor successfully adds a strong digital string to its bow for a specific niche?
It's a bit contrarian, betting on the incumbent adapting effectively.
Okay, that's one. Got another.
How about this? Maybe look at Fastenal preferred shares, if they exist and are accessible, hedged with short positions in companies really heavily reliant on, say, Chinese steel imports.
Preferred shares for the yield linked to the dividend increase.
Yeah, potentially attractive yield, given their history of navigating disruption, like these tariffs. The hedge comes from shorting companies, maybe without Fastenal's pricing power or direct customer relationships, who might get really squeezed by steel tariffs.
So isolating Fastenal's potential resilience while hedging broader industrial tariff risk.
That's the idea. Again, purely hypothetical, thinking outside the box.
Absolutely. Remember, everyone, these are just thought experiments, not recommendations. Do your own homework. Talk to an advisor. This is not financial advice.
Definitely not. So to wrap up the Fastenal Q1 deep dive, modest growth, some margin squeeze. Tariffs are a big focus being met with pricing and supply chain moves.
And a real strategic push on digital, especially for smaller customers, while FMI continues to power growth with larger ones. Plus, significant investments in inventory and CapEx signaling confidence.
It paints a picture of a company actively managing challenges and investing for the future in a pretty uncertain environment.
Indeed. What are your takeaways? Do you buy into their digital strategy shift? Let us know your thoughts. Always dig into the details yourself.
That's the key.
Thanks for tuning in to Talk Tickers. Join us next time for another deep dive.